The Money Show. Personal finance.
Big or small, Warren Ingram. What we're talking about here is big funds versus small funds. As an investor, are you likely to make more money investing with a fund manager that manages lots and lots and lots of money, or with a fund manager that is small, quick and nimble and invests agile, invests only small amounts of money?
Agile like a leopard.
So what is a big amount of money in terms, when you talk about a big fund versus a small fund, what are the metrics?
So if we're talking about in South Africa, let's look at the sector of investment unit trusts called equity funds. So those are the ones that only invest in shares.
Right.
And they're of course unit trust companies, like all product providers, like to complicate things. So this is the general equity category, which is then kind of what it says. It's the general stock market. It's not specific to financial companies or mining or financial or mining or anything like that. It's just the broadest part of the stock market.
So we're just looking this evening at general equity unit trusts, because otherwise we're going to spend 17 years here talking about all 990 or whatever they are available in the
I'll
universe.
get bored listening to myself.
Exactly.
So the in that sector, for me, to look at it, I would do a cutoff of about R1 billion is where a unit trust starts to become something of a heavyweight. But to give you a context, the biggest one would be about 37 billion, 38 billion rand. So that's to me is a big unit trust. A small unit trust on the other side of the spectrum is something that could be somewhere around 200 million rand down to around 18 million rand. 18 would be the kind of range of size of the small side.
And you might think that, if I invest with somebody who's managed to attract 30 billion rands worth of investment, it means that there are other people who think this person is terribly clever. And therefore, if they think he's clever, it must be clever to put money into that unit trust, because everybody thinks so. Whereas the guy who's running 200 million rand or 18 million rand, well, they haven't yet proven themselves because nobody else is throwing money into their fund. So let's go with the big guy.
Well, so I feel like it's a bit of an episode of Mythbusters on this one, because, for me growing up in the unit trust market in South Africa over the last 20 years, one of the things that has been a regular concern and a question raised to the big fund managers, and there are only a handful of big fund managers, is often the question will be, are you as big fund managers not so big that actually you become stagnant because you just can't move the market or you can move the market in a direction? In other words, if you decide that you're going to get out of your Anglo-American shares, as an example, and you own 8% of your fund in Anglo-American, and you've got 200 billion rands worth of assets under management, and you just sell out, that you actually move the whole market, and so you collapse the price of Anglos, as an example. And because they're so big, that their number of shares that they can buy is actually quite small, because they can't buy the company that's the 150th biggest share on the JSE, because if they do, they'll buy up the whole company. They'll literally own 100% of it. So that's something that I think is a good, sensible, rational concern. But what we find is that actually that has turned out to be a myth, because actually these bigger funds tend to really generate great performance, and the smaller funds generally don't.
If you are investing for the long term, and you are taking the Warren Buffett principle of investing for the long term, and your fund manager should therefore have a very similar philosophy. So if they're going to be buying shares in Anglo-American, they should be buying with the view of actually never selling.
Correct.
Because that is the Buffett philosophy. Never buy a share that you're not prepared to hold forever. And sure, companies come and go, and deals are done, and amalgamations happen, and cycles change, and there are times when it is probably appropriate to sell shares. But generally speaking, if you're a fund manager of a 40 billion rand fund, you're going to be, ensuring that it always has about 4% of Naspers or Prosus, and about 3% of Anglo-American, and about 4% of British American Tobacco. You're going to balance your fund out almost to reflect the market, which then raises the other question: why not just buy the index?
Yeah, and that's always going to be the great question. As you know, I haven't met an index yet that I don't like. So I think that is a great comment. And if you look at the fees of the big funds relative to the index, that's a compelling argument. And Standard & Poor's do this comparison of active funds versus index funds around the world. I think it's called SPIVA. If people want to have a look, it's really interesting.
How do you spell SPIVA?
SPIVA.
Okay.
And so when you look at that, you see that the number of active fund managers that are beating the index is just becoming smaller right around the world. So there is a real trend. However, the active managers that do get the outperformance do get quite a lot of outperformance. So there is still that argument that sort of sits in the back of my head going that yes, you can be in the index at a really low cost and just be done with it and carry on. But if the big, not the big, but any of the active managers, the quality active managers, if they come to the party by reducing their fees substantially so that they don't charge 5 times what an index charges, maybe they charge double, but especially double the price of a very low cost index, that maybe there's value there, if nothing else, for a measure of protection against very overvalued shares. So that's been the argument in my head.
And you would also think if you are a fund manager of a big fund, the 40 billion rand fund, and you are not constantly trading in and out of positions, you're not incurring massive costs. You're buying and you're holding over the long term, broadly speaking. You're not incurring massive costs within that fund. And so you're actually charging a disproportionate amount to the people who are entrusting their money to you if you are taking if you're taking that long-term view.
Well, I'm not sure about that. So I think one of the things for me to try and understand why have these big funds outperformed the small funds? Because I think we need to talk about why small funds would be good. And you were saying, that they could be agile, et cetera, et cetera. They can look very different to the market. And so there's a lot of merit in that argument, but the reality is not reflective of that. But if we look at the big funds, one of the things that they have done very well is they've obviously learned over long periods of time how to manage the internal costs of the fund. So they figure out how to be extremely efficient on those decisions about what to buy, when to buy it, and also how to buy it. And so that sort of inbuilt knowledge of those kinds of big funds becomes something that gives them a competitive advantage over a new fund manager, for example, and then a smaller fund. So I think I think also they get to push their weight around in terms of what they are charged for transaction costs. So from their perspective, they earn their money from growing the biggest pool of assets they possibly can. And so it's about growth of the assets. And so they want those transaction costs to be as close to zero as possible. And I think that's the trick, is they have developed inbuilt efficiency there.
Answer the question then. Does size matter?
Does matter. So what was interesting for me was looking at this initially in the States, because Americans always do the best research. And what you find is in the States, if we're talking about general equity funds, the big funds outperform the small funds by 1.5% per year over 5 years. 1.5% per year over 5 years is a big number. If you start to move that out to 10, 20, 30 years, literally the one will be double the size of the other. And that's an entire category. It's the 25% of the biggest fund managers against the 25% of the smallest. It's a huge dispersion. The other thing that we find is that if you look at international funds, so in other words, not American funds, but everything else, the rest of the world, that number is not quite 1.5%. Let's say it's 0.8, I think is the difference. It's still a big number. And then I looked at South Africa and I thought, I don't like 5 years. 5 years is quite a short term. Let's look at the 10-year numbers. And I didn't do the in-depth work that the Americans have done. But I said, okay, well, let's look at the biggest fund in South Africa. What did it do over the 10 years? And then compare that to the smallest fund that's still around, that has been around for 10 years. And what did it do? And the gap is 8% a year in favor of the big fund. That's
over 10 years. So that is an outperformance of 150%.
Yeah, I mean, it's a massive number. So
yeah, so if you'd put 100,000 rand into the small fund and left it there, and you'd grown it at 2% a year, you would have 115,000 rand. If you put money into the big fund and grown it at 10% a year over 10 years, you would have compounded 10% a year. I'm buying you time, Claire, as I slow down and speak.
I can't do
Warren. You're a financial advisor, not a mathematician. Yes.
So it's certainly more than double, right?
It's more than double. So you would have at least 240,000 rand. I'm guessing.
Okay. Cool.
You would have made a gain of say about 140,000 rand on that 100. You would have more than doubled your money over the 10-year period versus barely making an increase. You certainly wouldn't have kept up with inflation in the small fund.
And then look, what I thought is let's just be a little bit fairer to see maybe it was one fund that just had dodgy performance. It was one bad fund that happens to still exist, and actually everything else was fine. But then I looked at the bottom three performing funds, and so including that one, and they're all small funds, and they've all done below 5% a year. All three of those funds. So that tells you that over 10 years they're not even tracking inflation. So size definitely does count in this game. And
what about people who get themselves trapped in those smaller funds and they put money in and they go, well, if I sell now, I might miss out on upside when the cycle turns or when this particular focus of this fund changes. What happens if we get, instead of 1% economic growth, we get 1.5% or 2%, and then the local companies, the small companies in which this fund invests might just recover and be fine one day? Or do you just cut your losses and say, you know what, I learned a good lesson, never do that again?
Yeah, and so you're going from the science of investments now to the art. And it's an important point to make. So it's not just semantics, because the thing about investment decisions is, yes, you can do a rational calculation of value. You can look at the price earnings ratio of each of those underlying companies. But what you're eventually going to have to do is make a judgment call. And that's where the art comes in, is to firstly, the quality of those companies. What are their management teams doing in a dead economy? And why will those management teams do much better than the bigger businesses that are still operating in South Africa? And what's the potential for recovery? Because remember, you're talking about, if you're talking about a big fund, you can buy, those big funds can buy British American Tobacco and Richmond and Naspers and Prosus and all of those things, which operate, yes, they do operate in South Africa, but not really. They earn most of the money.
70% of the top 40 companies on the JSE's profits come from outside of South Africa. So you're nuts not to be in the top 40.
And now you ask yourself that if you're in a small fund and it's got a huge exposure to small caps in South Africa that are going to, by definition, they're going to be massively dependent on the economic health of the country.
But the valuations of the small cap sector, Warren, are wonderful. They're trading at multiples of 3, 4, and 5 times historic earnings. And those are all compelling arguments. The big problem is only the people who are investing in those shares, the small funds that are investing in those shares, are ever the ones to analyze them in any depth. The big guys aren't making the prices of those shares because they're never moving, because there's no activity in them. They just don't have the volumes and the scale required to be on the radar of the big investors. And it's unfair, but real.
It's exactly, and I think for them, they would just move around them. They're not going to move the prices of those companies. So I think the opportunity there, if there's an opportunity, it's going to be the high quality small companies go private. They delist, because they get fed up with the JSE, which I think is a great
But they
trend.
very seldom delist at the peak of their share price value. They wait for the share prices to fall to almost nothing. And you bought company A at R1 a share and you thought, oh, that was good, trading on a multiple of 6 times. And then they go through a bit of a rough time. The share price falls to 20 cents. They offer you 25 and you go, thank goodness, please take it away from me. And that's generally what happens when companies delist, when private equity comes in.
So your question is now, though, if you're still stuck in these small funds and you've had this 10 years of terrible performance, what do you do now? And so my argument there is cutting your losses and run in a situation like that, I think might be the right call. I believe that might be the right call. But if you're looking for the optimistic scenario, it's not that suddenly the economy kicks into 5% a year growth. I think the more likely upside from where you are right now is that a lot of these small companies that are high quality just delist. They just go private. You get a premium over what you currently have per share, price per share, and that's the scenario.
2008, there were 460 companies listed on the JSE. Today, there are 360 or thereabouts. There's been a significant reduction in the number of companies.
I started in 98, and there were over 900. And so, the numbers are just dying. And I think if I look at this, it's like we're watching a train wreck, both from an economic point of view, that's the one thing, but we're also watching the JSE that is doing absolutely nothing to rectify this. They make it harder and harder.
So to the point then, for investors in, unit trusts, should you not just be taking all your money offshore and buying the overhyped shares of Apple? The value of Apple today is the same as the 30 biggest companies in Germany.
In Germany?
Yes. How's that?
Some fairly decent companies in Germany.
And there's some fairly decent companies, but I mean, most of the big companies in Germany are privately owned anyway. But the 30 biggest companies on the Deutsche Börse, you look at the valuations of American companies, you go, well, it can't last forever, and it has so far continued for 11 or 12 years. And you go, do you go out of the frying pan and into the fire? Oh, and those are big choices that people have got to make, because for every year of returns you miss out on, and you keep sitting, basing your strategy on hope and optimism, you really corrode your ability to have a decent retirement one day.
Okay. So let's look on the other side of that argument. Is you were saying 70% of the value of the JSE is determined by overseas markets, overseas income, etc., etc.
Yeah.
And so that's the thing not to lose sight of. Is so to say get out of the small company side or the SA Inc. side of the market is one argument, and I think there's merit in that for now. But to get out of the JSE in its entirety, where you then get out of those high quality global businesses, because Richemont is a high quality global business. No matter what you say, that's a good business. It might be, the price might be high or low, but there is the opportunity to make money out of that. And I think BAT is smoking again. So those kinds of things you can access here. And then the whole Naspers story, which we for decades kind of keep saying it can't carry on going like it is, and guess what, it carries on. Those are quality businesses. So I would say be careful of just bombing out of the whole JSE.
Absolutely.
In that change.
More. Yeah, absolutely. Couldn't agree more.
And Europe's fine. I think and Europe's not expensive like America is, and there are parts of America which aren't expensive. And then I think lastly, just back to the JSE, the emerging markets have underperformed the world markets and the US market by more than 10% a year over the last decade. Now think about the size of the economic growth that we've seen from those big emerging markets over the last decade. And economic growth eventually leads to market growth that, they don't go hand in glove straight away, but no. there is a merit there. So and South Africa will benefit from that, because when the world decides to buy emerging markets, they just buy them. And so I think be careful there of just bombing out of the JSE. I think that's a really dangerous call. But the thing around small funds, it's a good point to note. It was something, when I looked at this, I thought, wow, for me, that was a myth I've believed.
No, absolutely. You would think that the little guy, the David versus the Goliath, that David can, pick up put a stone in a slingshot and can hit the big guy square between the eyes. But the big guys got the buying power, they got the muscle, they got the pricing power. Their performance, as the data shows, dramatically outperforms the smallest guys. That is a very sad story for the small guys, I'm afraid. Warren Ingram from Galileo Capital. He's the director at Galileo Capital. He's a personal financial advisor. He joins us on a Thursday evening to take us through the emotional world of investing, because it is emotional. And it shouldn't be, but it is.
And every time we get load shed, our emotions get worse. And I think that's...
And it's coming. We are 90 minutes away from load shedding. See, I said with a happy voice, it sounds like it's a good thing.
You can make anything sound good.
You can get to bed earlier, and we can have a population explosion in time for Christmas.
Just what we need,
another million people. So keep your if you're going to bed early tonight, keep your trousers on.
Do you think there's going to be a population explosion in China?
Why would you ask me that question? I'm sorry.
Because there's a coronavirus.
There's a coronavirus, and
everyone has to stay at home.
Everyone has to stay at home. I mean, I don't know if people are even talking to each other at home. They must be so scared. I mean, and again, just from a logic and calmness point of view, if you look at the power of China to turn it on in a crisis, I've never seen a response to a crisis like we've seen in China. They're treating it deadly seriously, building those, I think it's 1 or 2 hospitals.
2 hospitals.
Within a matter of days. And not a couple of containers, with an army tent between them. I mean, these are proper structures that have been delivered, and proper quarantines and scary military state stuff, but designed to stop the spread of something that could be devastating for the globe.
Yeah, I mean, I think if you look at what happened at the last one, it was a big deal. A lot of people didn't die. It wasn't as if the population was suddenly decimated, but the economic impact was enormous.
Yep.
So I mean, I'm glad that they're taking it this seriously.
You see, Warren Ingram, glad. Warren Ingram from Galileo Capital.